Hi, everyone. Okay, so we're going to start in 4 minutes at 5 past, just giving everyone time to join in.
Yanmo, I think your microphone is muted.
Yes, it was muted. I'm saying you're our quickest ever sign up. This is exciting.
Oh, great, great.
Yeah, everyone's looking forward to it.
Yeah, me too, very much.
Okay, so as everyone's joining, we're going to start at 5 past, so just giving it 3 more minutes. Yes, there will definitely be a link to recording after this event. Hi, everyone. Okay. So it's 6 p.m. It's 6 p.m. for us in Lagos, so a bunch of people are. So everyone's either commuting or just getting home from work.
No, that's fine. That's okay.
Okay, we have 1 more minute to go. Just trying to make a quick transfer. Hi, everyone. Let's see. Hi. This is exciting.
It's great.
I'm reading the comments. Okay, I think we're going to get started now. Just sending off something. Okay, hello everyone. Thank you all so much for joining us today for another edition of Under the Bamboo Tree. If today is your first one, we try and have these every month or every couple of months where we get an industry expert to help us learn a little bit more about the stock market. Today, you're all very, very lucky because we have Emmett Savage from MyWallSt. MyWallSt is one of our favorite partners at Bamboo. And apart from being one of our favorite partners, Emmett is actually helping me build an amazing portfolio with his Horizon product, which he'll probably talk about later. And apart from that, he'll tell us a bit about his experience, but he's been investing for a lot of years and has built portfolios through crashes and through ups and downs, and really understand how the stock market works, and is going to hopefully give us some insights on how we should build our own, how to build portfolios. So thanks a lot for taking the time out, Emmett.
Thank you, Yanmo. I'm absolutely delighted to be with you here this evening. As you know, we're partnered, MyWallSt and Bamboo. I think we're pulling each other up the bamboo tree, and I'm really happy that we're together here this evening.
Yes, perfect. So we're going to just get started, I guess. So for a lot of us here are new to investing, a lot of us in our first couple of years as investors. And I guess, so my first question is, how would you tell us a little bit about your first couple of years as an investor and just generally about your investment journey? And,
Yeah, absolutely. I'd be delighted. So I studied physics from 1992 to 1996. And when I was in college in Dublin in Ireland, I saw the internet for the first time, and it was a whole new invention. I'd never laid eyes on the internet. So I started a blog on the subject of stock investing, which was nothing to do with what I was studying, but I was very interested because, as you know, Yanmo, and as your customers know, and your community understand, I love the idea that when you buy a share, you own a little piece of a business. It's like that belongs to you when you buy a share. So I started blogging on the subject of the stock market, and it was the birth of the internet in, I guess, most people's lives. So it was very, very unusual for an Irish guy to be blogging about the US stock market in the late 90s. I mean, somebody once said to me, it was like finding a talking dog. It was so unusual because nobody in Ireland was an investor in shares at that time, most certainly not in the US stock exchanges. So I regard myself as, it was the birth of the internet that gave birth to my fascination with the stock market. And as you know, in the late 1990s, there was a huge bubble building up, which was to become the dot-com bubble. But it was driven by several things. Stockbrokers were starting to open online platforms in which people could now suddenly access their stockbroker over the internet. These online brokers had low fees, and there was all types of advice available to normal people from everywhere. And that advice ranged from free right through to very expensive advice. And I was in the middle of it, writing a blog about my lessons about the stock market. And that's how I really, I began. It was really, the internet was what gave birth to, I suppose, democratizing the stock market, just as Bamboo through mobile internet is democratizing the stock market in Nigeria. And so my first 2 years, when I reflect on them, are characterized by optimism. Like optimism drove all my decisions, feeling very optimistic. But optimism doesn't always win out. Like, you know, a bad decision is a bad decision. So I think I learned all my lessons in my first couple of years of investing, because the dot-com bubble burst in the year 2000. I, along with so many people, lost everything I built up through the stock market. But what was most fortunate for me is that the dot-com bubble burst when I was 25 years old. So I had learned all the lessons, or at least a lot of the hard lessons, the hard way before my 26th birthday.
What would you say lessons you learned that helped shape your investment strategy?
Sorry, Yanmo, would you believe I couldn't, that didn't come through? I have visual, but I don't have the audio.
As my internet all right? Is it working now?
Yeah, I can hear you. It's not perfect, but I can get it.
Okay, I was saying, what lessons did you learn during the period that helped shape your current investment strategy?
Well, My Wall Street has 6 golden rules that are the lessons I learned 20 years ago. And I'll tell you what I'll tell you what those 6 golden rules are, and then I can elaborate on them if you wish, but these 6 golden rules have formed the basis of everything My Wall Street does, but it's also what the greatest investors, and I'm pointing over my shoulder here because I've books written by all the world's greatest investors here, but these 6 golden rules are common to the most successful stock investors. And the first one is a very simple one, and it's almost not worth saying, but I'll say it anyway, and that's get started. You cannot create generational wealth unless you start. Just the way you can't, get fit unless you exercise, or you can't, learn about something unless you open a book or practice it. So the first golden rule is get started, and that's a very simple one. And I know that Bamboo is doing an exceptional job at getting people started. That relationship that happens when you move from never having done something to having started something is really special, like the first day at school or that very first important moment. So when you get started, you're on the road. The second really, really important rule is to think long term. And that, the most important factor if you're going to be a successful investor, the most important factor is a commitment to doing this for years and years, and in fact, decades and decades, if possible. So the younger you can start, the better, but you should start today. It's like the best time to plant a tree is today. If it's not today, the best time to plant a tree is tomorrow. So think long term. You must think long term, because only with time can you approach certainty of returns. And I'll elaborate on that point in a while. The third golden rule, so the first golden rule is get started. Second golden rule is think long term. The third golden rule is never borrow money to buy shares. There are a lot of things in your life that will require you to borrow money. A lot of people borrow money to buy a home. They might borrow money to buy a car, but you should not borrow money to buy shares, because invariably, the interest rate on the money lent to you to buy shares is way higher than the interest rate when you go to buy a home. And one of the, reasons that the dot-com bubble hurt me so bad was I had borrowed on margins from my broker. So, it's all good when the market's going up, but when the market goes down, you still owe that amount of money. So if your folio is here and it's approaching a debt level, your broker is going to start to sell shares. So the third mistake is, the third golden rule is never borrow money to buy. The fourth of 6 golden rules is diversify. And I know, Yanmo, you totally agree with this, that you should never buy just one share. You should never decide, I love Google and it is the only share I'm going to buy. That is a big mistake that a lot of early investors could possibly make. You have to commit to buying several shares. And the rule that we have at MyWallSt is you should try and aim to own at least 12 shares within a year. And then it's easy for people to get their head around it. That's like they'll pick one a month. It's not too fast, it's not too slow, but the minimum you should have in your portfolio is 12 shares. So the fifth and second last golden rule, the fifth golden rule is you have to buy what you believe in. And that sounds a little bit, I suppose, I need some elaboration, because people sometimes don't know what they believe in. If you're new to something, you really need a little bit of assistance in understanding what it is that you believe in. So buying what you believe in is a very important factor, because if you've ever bought something, I'm talking about shares, but if you've ever bought something that you don't like, might be a car or a home or a piece of clothing, it never feels right. You have to believe in the stocks you own. And that is something that we at MyWallSt have, I suppose, a speciality in, which is we help people understand what they believe in. And we create a short list of great businesses and we go, look, everything in here is a good investment. So pick one you believe in. And then the last of 6 golden rules, Yanmo, that we live by is invest what you can when you can. And that is means don't create strain in your life, but add a little money often, because the creation of wealth is unlocked by adding some money on a regular interval, as opposed to starting off with a lot of money and only using it. And the greater investors who end up with far, far more money are the ones who start with a modest amount and add a little bit often, as opposed to those who start with a lot. Because over the long term, adding a little often creates true generational wealth. So that's our 6 golden rules, Yanmo. It's a long answer to a short question, but I thought it was worth just kind of putting it out there, and hopefully your community will derive some value from that. Sorry, Yanmo, I can't hear. I'm really, now you're back.
Oh, lovely. Can you hear me now?
Yes. The only thing I could hear, Yanmo, was you saying, can you hear me now?
Oh, can you hear me now?
Now I can hear you.
Oh, sorry. So I was trying something different with my audio and I didn't realize they were connected. I thought
no problem. That's online life. Every meeting is like this. Don't worry.
Yeah, we're still figuring Zoom out. Also, that's lovely. That's actually really interesting to hear. And guys, so just 2 things before I continue is, first of all, is if you want to tweet about this, use the hashtag #UnderTheBambooTree and hashtag MyWallSt. And second of all, if you have any questions, we'll get to them at the end. So if you please use the Q&A, just so that we don't miss any questions if they're in the chat. It's just easier for housekeeping. Okay, so Emmett, those 6 points were amazing. And so, but for most of us here, we're all trying to build $1 million portfolios. And what sectors would you tell us, what sectors would you describe as must follow? How do we start building conviction for what we believe in?
Well, the first million is the hardest, and then the next one isn't so hard. And that is actually a fact. But the sector or the industry that I think I'm going to talk about 2. So like the must follow industries that I believe have the greatest potential to, expedite wealth and become, make your first million or build $1 million portfolio. The first is software as a service, or SaaS. And software as a service is a very appealing area of the business world that still has a lot of growth left in it when you actually measure the entire industry. And the reason software as a service is such an appealing area is that there are new players coming in every aspect of delivering products to our lives as individuals, and also delivering products to other businesses. And the nice thing about a software as a service business, as I'm sure you all know, is that it's recurring revenue. Businesses can tighten a product, increase prices, introduce new products, and the channels of distribution are already built through the internet. And software as a service has so many choices. And I'm going to give some examples later on, I'm sure, on software services companies that I particularly like, and I'll explain why. But I believe that certainly software as a service is one that should occupy quite an amount of attention from the Bamboo customers. The second of 2 that I think is really worth people exploring in detail is business to consumer companies. Because I have, at this moment in time, let me just see, I have 1, 2, 3, 4, 5, 6. I have 7 stocks. I have my brokerage account open here. I have 7 stocks currently up over 10-fold or more. That's up over 900% or more. And 8 of those 9 are business to consumer businesses. And the reason I love business to consumer, there's a lot of solid reasons, is that when you have a product that appeals to very, very many, thousands or even millions of people, it's way, way harder to go bankrupt. And it's way, way harder to go wrong, because the world forgets and forgives mistakes if they like what you do. And I have one of my stocks at the moment, one of those 10 I listed is called Chipotle Mexican Grill, which is a restaurant chain in the US. You probably know it, Yanmo. And I'm up 21-fold on it. I'm up 2,089% on that. And about 3 years ago, they, in their guacamole, there was it got people sick, got people really sick. And suddenly nobody wanted to eat Chipotle food. A bacteria grew in the avocados that was beyond their control. People got sick. But the world forgets. When they like what you do, they forget mistakes. Everybody's forgotten the bad products that Apple has released, and they have released bad products. People forget about Disney movies that were awful because they know everything else is good. But business to consumer, B2C, creates millionaires. And my biggest investment winner is Netflix. I'm up right now I'm up 19,922%. I'm up nearly 200-fold.
Oh, wow.
Yeah, I bought that 15 years ago. I'm out to find these again with Horizon. I will repeat this, but that's another story. But Netflix is like, it only takes one great investment to warp your entire net worth positively, to change your life. And Netflix was my life-changing stock. Tesla was another one. I bought that, I must have been 15 years ago. But the point is that these are business to consumer businesses. They are selling stuff that anyone on this call can observe or buy. You know, like we could all sit together in a big room once coronavirus is gone, and we could all try Coca-Cola's new product, and we could have a discussion. We don't need to be industry experts. We can just use the brain that, you know, was given to us. And B2C is there is so much money to be made in B2C, and that's because we as a collective can be very intelligent. We don't need industry insights. We don't know it's special software for the automotive industry, and we don't know, but B2C. So in short, your two questions, the two areas that I feel very excited about are software as a service and B2C.
And B2C, that's very, very interesting, actually. That's interesting. I mean, I like SaaS businesses. B2C, it depends. Some people like, you know, I think there's different school of thoughts on B2C. People like the security of B2B businesses, you know, big companies, big revenues.
Yeah.
So that's always interesting.
Yeah.
So another, you know, and as you talk about this now, just generally, there've been a lot of businesses making a lot of waves in the headlines. And, you know, it's easy to get carried away making rash decisions because of flashy headlines. And, you know, what are some industries you think investors are overlooking because they're not always as glamorous?
Oh,
that,
yeah.
You know, it could be within the SaaS and B2C, or just.
Well, I think that there's an industry that the world has dumped and left for dead because of the world we're in at the moment, and it's REITs, real estate investment trusts, And for your listeners' understanding, you can own property. You can buy property on the stock exchange. You can buy a company that does nothing but builds hospitals across Europe with a REIT. You can buy a company that builds the towers for mobile coverage for 4G and 5G and 3G and all the other Gs through a REIT. And there are, in this coronavirus world, we all know it's caused a change in behavior. A lot of us are working from home, those of us who can are. And there is, for example, a real estate investment trust, to give a very specific example, that I think is oversold, that I think is actually cheap right now because it's not part of all the hype and the excitement. And that REIT is the Empire State Realty Trust, and its ticker is ESRT, Empire State Realty Trust. And the Empire State,
ESRT?
ESRT. Think of the Empire State Building, ES, and then the Empire State Realty Trust. So the Empire State Realty Trust portfolio has 14 properties in New York and a whole pile of retail space, and of course the Empire State Building. So it owns the Empire State Building in the middle of New York City, which recently completed a massive renovation of its observatory up on the top floor, which just before the pandemic, by the way, was generating nearly $40 million in revenue per quarter. That was before they renovated it. So when things return to normal, and considering, you know, that it's a better experience, we can estimate and guess that like the Empire State Building from the top floor alone is going to deliver about $160 million in revenue a year. It owns the entire Empire State Building, properties all across New York. And here's the thing, the shares have just been destroyed. They are down on the floor because, well, because everybody's worried about the future of cities and the future of office spaces. But right now, that company, that REIT, the Real Estate Investment Trust, called Empire State Realty Trust, it has $1.4 billion in cash. That's a million with a B. The $1.4 billion in cash. They are starting to buy property at bargain prices, and the stock is sitting within pennies of its all-time low. And that is an example of just one of thousands of REITs that has been destroyed because of coronavirus. It was like a $22 stock a year ago. It's now about $6.20, $6.30. And if you believe, and this is buying what you believe, if you believe that cities will rise again, that people will come back eventually when coronavirus is cured and we're vaccinated or there's good therapies, that is an example of a business that has been overlooked and is not glamorous.
Okay, so that's interesting. So, you know, if you're looking for something, real estate investment trusts are a good one. Another industry that has been in the news a lot, SPACs and electric vehicles are some of the most talked about investment areas right now. How do you feel about them? And, you know, how should investors examine opportunities when with all the hype around them? And, you know, one that comes to mind is Tesla. Is, you know, should we be buying Tesla now? Is Tesla too expensive? The other EVs, how do you feel about the industry? And generally, how do you feel we should be looking at overhyped industries?
Yeah, well, hype is a dangerous thing, and because what happens with hype is that inexperienced money pumps the price up. People aren't too sure why they're buying, but they know everybody else is, so they want to buy it. And SPACs and electric vehicles, you're right there. One has been hyped. The electric vehicle market has been quite hyped and has had a run. SPACs less so. And I might explain for your listeners in a moment just what a SPAC is, a special purpose acquisition company. So a special purpose acquisition company is when a rich person, generally a rich woman or man, says, I'm going to go get a whole pile of money. I am going to list a shell company on the stock exchange. And then when all that hard paperwork is done, because it is hard to list a company on a stock exchange, I'm going to go and buy a private business or invest in a private business, and overnight it's going to get floated. And the appealing thing to the founder of the private company is they don't have to do all this hard work and they get a giant check. So as it happens, I quite like SPACs, and I think it is a nice way for a business to float on the stock exchange. But the challenge with a SPAC is you invest in it generally without knowing what company it's going to go and invest in. So I do like SPACs, and it all comes down, it's called you're backing the jockey instead of the horse. It's a horse racing, you know, analogy, and you are really betting that the person who's running the SPAC has the knowledge to go and the contacts to go and get a good one. So I like SPACs as a broad rule. Electric vehicles, well, you know, when we were talking earlier, Yanmo, I think you're going to ask me a few questions about the different electric vehicles, and I'm going to give you a view on all the different electric options out there. So happy to dive in now, or we can go through them in a while.
Yeah, we'll go through those in a while. So a little bit more, you know, more focused on our exact topic today is building a portfolio. And so I guess the first question I have is, what are the 5 best performing stocks in your portfolio, and how long have you held them? And then I'll probably have a couple of follow-on questions.
Yeah, my biggest winner is Netflix, and it's up nearly 200-fold. So it's up nearly 20,000%. My second biggest is Tesla, and I'm up.
Sorry, how long have you held it?
Oh,
Netflix?
Netflix. I started buying Netflix when it was split at just at $1 a share. So I think I've had Netflix for about 15 years, maybe 13 years, a very long time. But it's only the last 5 years where it's gone whoop, like a hockey stick. So this is the long-term thing.
So 15
Tesla.
years Netflix.
Yeah, a Tesla. I have Tesla shares at least 10 years. I haven't logged in to see when I bought, but I'm up 2,104%. So I'm up 22-fold on Tesla. My third biggest winner is Chipotle Mexican Grill, the restaurant company, and I'm up 2,089% on that. So I'm up 21-fold on that. And then my fourth biggest is Shopify, which I'm up 1,184% on. So that's 12-fold I'm up. And my fifth biggest winner is, well, in joint place, actually I've three stocks in joint fifth place, and that's Disney, Zillow, and Facebook. And they're all up just nearly 1,000%. One is 580, the other's 570, the others, sorry, I mean to say 956, 924, 917. So they're all up tenfold. So Netflix, Tesla, Chipotle, Shopify, Disney, Zillow, and Facebook. And I have owned all of those for at least, I'm going to say 8 years. I'd say the average holding period of all those stocks is 8 years.
Okay, so that brings us to a very important question when we're thinking about our portfolios, is that when you say long term, are you telling us that we should basically be holding forever? Otherwise, when is it time to cash in our gains and either reinvest or take our money out, or, you know, what should be our strategy here?
Yeah, well, on the top line, very long-term buy and hold is the path to wealth creation. Like, so the first thing is like long-term buy and hold. Like, the news is very distracting. It's impossible for us, as there's nearly 300 of us here on the call, as intelligent creatures, to see the news and not think, what does this mean for this company I own? So we try and create a bridge between news about a stock we own and whether we should sell. So every mistake, Yanmo, every mistake I've made as an investor is related to a sell as opposed to a buy. And there is a friend of mine in America who's a very successful investor, and he figured, he got one of his interns to figure, had he never sold anything, his annual return would be up by 2 percentage points had he never sold. So I'm not saying that every stock is deserving of never being sold, but it makes it easier if you have a rule, which is never sell. And the other thing is, and I'm not too familiar with Nigeria's tax laws, but if you sell a stock, you know, capital gains tax is a reality, and your government is going to want their little piece off the top. They're going to say, you made a profit on this stock, give it to me, you know, and that has a...
Okay, so we luckily don't have this, thankfully.
Okay, well, that's good. Okay, well, that is good. So hopefully that never happens. Well, then at least you're a little freer to make decisions. So the worst thing, I mean, I have now, all my mistakes, as I said, relate to sales. I suppose tax is a reason not to, but the real reason is you will sell winners. So if you put 95% of your effort in before you buy, and then just put 5% into watching it for a very long time, you will do better than if you decide to sell winners when they double or triple. Like, I'll give you an example, and I'll give you just 3 examples. So I told you who my biggest winners are: Netflix, Tesla, and Chipotle. Along the way, I sold almost half of each of those positions because it was up so much. It was up 5, 10-fold. Those stocks went up to grow 20-fold, 100-fold, 200-fold. Had I done nothing at all, I would have made far, 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 far more money. So, but by the way, Yanmo, I'm not trying to evade the answer to your question, but when to sell is the one answer that no 2 stock investors can agree on, but a lot of them say never.
Okay, no, but then, so when would you say is there ever a time you would say it's a good idea to sell this now?
Yeah, yeah. Well, there is, and it's when the company's strategy has changed. A company will have a bad quarter. Like a quarter is only 12 weeks, and it's crazy in America that companies need to keep reporting every quarter. And they might have a good quarter, they might have a bad quarter, but that's just like the changing weather and the changing seasons. We shouldn't be worried about that. But if a company makes a strategic change, or if we find that the management of the company has in some way lied to us, sell. And the only sell I've made in the last 3 years, Yanmo, is a company called Luckin Coffee, who are like the Starbucks of China, and their management team lied to us retail investors wholesale. We were being told lies everywhere, and I don't want to own a business where I can't trust the managers. We will forgive bad quarters. So if there's a strategic change, or if we find that the leadership don't have integrity, sell. But from a valuation perspective,
Okay.
no, if you've got a quality business out to change the world and they're giving an honest effort, leave them to it. I guess I'll give another rule, but if you don't feel it anymore, you got to own what you believe in. And if you bought a share, 20 years ago and you believed in it passionately then, and now you're like, I don't believe in it anymore, that inner voice, I often say that your hunch is the culmination of everything you've ever learned and observed, brought down to a little single point in your head, a spark in your head. That's your hunch. Well, if your hunch is, if you've an informed hunch, a hunch that you've worked on for years, you will get to a place where you might just feel, I just don't want to own this anymore. So you don't want to own it. The management team are corrupt or untrustworthy, or the business has fundamentally changed its strategy. They're the three main reasons why I would sell.
Okay, so you've told us when to sell, and now I'm interested in, the fun part, the buying part. What are we buying ahead of? So you've told us all the money you've made in over the past 15 years, and we would like to have these kind of stories in 15 years. So, what new positions are you entering ahead of the decade? What existing positions are you adding more to? Essentially, what should we be buying going into the next, 10, 15 years? Where's the next, 200-fold?
There's a lot of great companies, and there's always a good investment today. That's the first thing. There's always a great investment. I can talk about Netflix up 200-fold, but Netflix is now a giant, and it won't grow 200-fold from today. So what we need to do is find businesses that today look like Netflix did 15 years ago. And I'm managing my own personal money in a service called Horizon, which I know, Yanmo, you're subscribed to, which I appreciate. And in that service, I tell everyone about the stocks I'm thinking about buying and the ones I'm actually buying before I even take an action. So all new money I'm investing in my life is going via Horizon. There's nothing else going on the side. But getting to the point, to give you some name now, I'm trying to, I suppose we have Horizon customers who've paid for the privilege of knowing exactly what I'm buying. So I won't give you all the list, but I'm certainly happy to tell you stocks that I really, really strongly believe in. And if somebody walked in the door and said, there's $1,000, I'd buy them like that and leave it there for 10 years. So one, for example, and it's coming back to B2C and software as a service all in one, and it's Teladoc. So Teladoc.
Sorry, just a quick thing for anyone that doesn't know. B2C is business to consumer. So yes, people who are selling one by one, as opposed to selling to businesses. Sorry.
Oh yeah, sorry, yeah, no, that's it entirely. Yeah, B2C, it's written down as the letter B, the number 2, and the letter C. And so business to consumer is like Coca-Cola, and then B2B, or business to business, is one that sells things from one business to another business. And you'll never see that on the shelves. Sorry, Yanmo, I don't mean to get jargony. So, so business to consumer, I told you earlier, I like, and software as a service, I like. And one of my favorite investments today for the very long term is called Teladoc, and its ticker symbol is TDOC, like doctor. And Teladoc is a company that is bringing to the internet medical care. And for a world, there is so many people who cannot reach a doctor. They're in they're too far from a doctor. They can't afford to go. It's too there's there's bringing only 3 out of every 10 doctor visits required a doctor to touch you. 7 out of 10 allow you to actually get diagnosed via a computer screen like this. Teladoc is the giant name in delivering medical care to tens of millions of people every day. It's a platform. Think of it like Airbnb of doctors, but they have every type of doctor there. So I think, to answer your question, that a stock that I truly believe is going to create generational wealth over 10 plus years, because that's the time frame we're talking about. It's Teladoc. And where it's going to be next week, I don't know. You never know, because the shorter your time frame, the harder it is to predict. Okay, so that's Teladoc. Okay, anything else? Any more gems for us? Or is that all we get? Sure. No. I've got there are a lot of stocks I like at the moment, and so for example, I think Etsy is a very nice business. I think Peloton. I think Pinterest is a very nice business. I also think from the old world, we've got Hasbro, who like games like Monopoly, and I also like a Brazilian player called StoneCo, and StoneCo is okay. Yeah, it's like the PayPal, if you like. Well, they're a Brazilian business. They're focused in Brazil, and it's democratizing credit card payments. It's something like the PayPal and Square of Brazil. It's a bit of a hybrid of both in Brazil. So they are all stocks that I think are very appealing for the long term. Okay, and a question regarding all these stocks. You know, there's a lot of discussion now about the market being high, being expensive. Are these stocks you would buy today? Like, would you go out and buy these stocks today, tomorrow? So the hardest thing to predict is a downturn. Nobody can predict a downturn, not even economists. Very often economists can't even agree why a downturn occurred when it's the past tense. So what most investors fear is, well, if I invest my money today, is the market going to go down tomorrow? And that's a valid question since time began. Coca-Cola floated its business 101 years ago. In 1919, Coke listed on the stock exchange. And from that day to this, every day you could have said, should I buy it? Because the market might go down. But the truth is, in building a good portfolio, you don't go all in on day one. You buy a little bit of a few companies, then you add to it later on. And in fact, what I'm doing with Horizon is hand-holding people through this process, because it's not a distinct rule, Yanmo. You don't just say, right, buy everything now. But if the question is, would I buy those companies today? Yes, I'd buy shares. All I've ever done is buy. I don't worry about what might happen. I find quality businesses, I buy them. And don't forget, you're not wrong till you sell. So if you buy a stock and it's down 20%, so what? Who cares? It's like if you bought a house, you only lose if you sell. But if we're going to create your company, Yanmo, is going to create more millionaires than you know. But all of them will have obeyed the 6 golden rules I told you. And the ones who lose money will panic when the market is down. And I think a lot of your customers, if they care to join the Horizon service, will expedite their wealth. And this suddenly sounds like I'm going into sales pitch, but I'm not. But the fact remains, I am going to create a wealth generating portfolio at Horizon service that I'm running. And whether you sign up for that or not doesn't matter. The thing is, if you just get started, never borrow to buy, diversify, and go long, you are on the front foot to create vast amount of wealth over the course of your life. Okay, so that's great. So you heard it from Emmett. Stop trying to time the market. Just buy now, because anything can happen, and you're never wrong until you sell. So even if it's down, you can continue holding. A lot of people are very, very are there any stocks you're currently selling right now?
just before we get
No.
on to Horizon?
No, the only
Okay,
stock
so we're
I've
not
sold,
selling.
yeah, no, Looking is the only stock I've sold in at least 3 years, maybe 5, and that's because I lost trust in the management because they're corrupt. They were corrupt.
Okay, so finally, you said a lot about Horizon, and can you tell us a little bit more about it? How do we get involved? How do we get on?
Yeah.
Just tell us
So,
about it, and how will it help us make our $1 million portfolio? For just full disclosure, I have Horizon. So,
thank you, Yanmo. I appreciate that very much. So I'm out to build a legendary portfolio with Horizon. That's the top line. And what we're doing with what I'm doing, there's no we. What I'm doing with Horizon is I'm taking $160,000 of my money. I'm going to buy 20 stocks with it, and the ambition is to turn it into $1 million. And that's going to take like 12 years. So we have to go long, but we will do it. And Horizon is a very exclusive service. We only onboard people every 3 months. We only bring in a select number of people. And as it happens, next Wednesday, I'm going to give a seminar, which is packed with value, as I hope this one is too. But next Wednesday at 5 p.m. Nigerian time and Dublin time, I'm going to be holding a workshop called The #1 Way to Measure and Improve Your Success as an Investor. Okay, that's next Wednesday, 5 p.m. And just this week, it's effectively going to be explaining the tool that I've used for 20 years for measuring my own performance. At the end of the seminar, everybody's getting it free of charge, no hooks. They're just getting this spreadsheet that I've used for nearly 20 years, 19 years. And I'm going to tell people how to master the most misunderstood and counterintuitive secret of long-term wealth creation. And that is next Wednesday, 5 o'clock. And all people have to do to sign up is go to mywallstreet.com/workshop. That's mywallst.com/workshop. And you'll learn the only metric you need to measure your portfolio's performance. Now, here's the thing. In that seminar, you can sign up for Horizon, and we only do this 4 times a year. So if your listeners want to sign up for Horizon and join the community that you're part of, Yanmo, and I'm very appreciative of you being with us, just go to mywallstreet.com/workshop. And next week, I promise you, if you never bought Horizon, you will be glad you came next week, because the spreadsheet that I have will help you unlock some really cool stuff in your mind, and I'll explain it when we're on that call, mywallstreet.com/workshop.
Okay, that sounds really, really good, and really, really interesting. So now we play 2 games every time we do this, and it's always fun. We always get new different answers, and a lot of the time people join in the comments. And the first game we play is toss or keep. And the reason we play this game is because with all the coronavirus hoopla, going on, the market's going crazy, everyone isn't sure right now whether we should be. A lot of people haven't obeyed your 6 rules, and a lot of us have just been buying because stuff was exciting.
Yeah.
And should we be keeping the stocks we bought, or is this probably a good time for us to sell and say bye-bye and do proper research? So we're just going to throw out the names, and you're just going to say toss or keep. And then, I know for some, you might feel like you want to give us some more background, and you can also do that because we understand why it's necessary. Yeah?
Yeah, ready.
Great. So we're going to start with the EV. And guys, in the comments, you can also throw some companies in there if you want him to answer your question. But that's after we've gone through our bamboo team stock. So Tesla, actually just the EV space in general, and then Tesla, Nikola, or Phyllis.
Okay, Tesla keep. Yeah. So Tesla, Nikola, and Electromechanica, which is ticker Solo, are the 3 big. I'm just going to give you 60 seconds about those, and then I'm going to tell you toss or keep which one. So they're very different profiles. Tesla is $412 billion in size. Nikola is $12 billion in size. So like Tesla's $400 billion bigger. Nikola's $12 billion. And then Solo or Electromechanica is $170 million. It's like a tiny little gnat floating away in the wind. But despite being invested in Tesla for a very long time, and it now is a giant company with a razor and blade business model, I think is someday Tesla will be the greatest AI, artificial intelligence play of our generation, of our entire life, because the cars they have built are recording every mile driven. And when that's all meshed together, not only will they self-drive, but they will take away road deaths, which is the biggest killer of children and young adults in the whole world. So I think Tesla is going to be the greatest company of our lives. So it's buy.
Oh, wow.
I think Nikola, jury is out. I'm kind of going to say toss, but I might be wrong. And then Electromechanica, it's so tiny. It's very risky because it's so small. Like it's a $170 million business. And when the smaller the company, the bigger the risk. So I think they're doing something nice, but I would say only put a tiny amount of money in if you like it, and have a look at their website, and they have funny little cars. But I would say it's very, very risky, very, very risky. But I'm going to say keep. Okay,
so a quick question on Tesla. Should we, for those of us who still haven't bought Tesla, I'm one of those people. And interestingly enough, Tesla was our stock of the month in September. Well, no, whenever we launched, so October, and I still didn't buy it, and I still haven't bought it. Should I buy Tesla?
I don't think there's a rush to buy Tesla, Yanmo. I think you should buy it, but I don't think you should end the call and buy it tomorrow, because it has had a big run. We all can see that, and it's horrible when you've seen a stock. Every person, the best investors in the world, look at these and, oh, I missed it, and that is the feeling you feel, and you're like, I better buy it now to get rid of this feeling, because you want to get rid of the feeling of having missed it, but you don't want to buy it when it's too high. I think the stock market is going to pull back a little bit in the next couple of months. So my answer to you, Yanmo, is I think you should buy Tesla. I don't think you should do it tomorrow, but when you see a dip, I think you should, as they say, graze, take a little bit, and then start to build a position a year ahead.
Yeah. I mean, to be fair, I haven't bought Tesla just because I think Elon Musk is slightly cuckoo.
Yeah.
So, yeah.
But geniuses are all crazy.
Okay.
All the geniuses are crazy.
Are you crazy, Emmett?
Are you?
Okay, Virgin Galactic.
Big fan. Love, keep.
So we should buy it? Toss or keep? Keep?
Keep.
Okay, pharma.
Buy
so
and never sell
Moderna.
it. Buy and never sell it, trust me.
Pharma, so Moderna, Novavax, that lot.
Can I talk, or do I have to go toss or keep first?
You can talk. I see why you need to with pharma. So we'll let this one slide.
Yeah, okay. So 170 companies are actively developing a vaccine for coronavirus. 9 of them are in phase 3. You know, we don't know which one will get approved. So it'll only take 1 or 2 to get approved in order for all the other 170 to retract. So the chances of picking a winner are stacked against us. Like already 170 companies are out to cure coronavirus. 1 or 2 might do it. And even then, we don't even know the economics. So imagine you and I were given the cure to coronavirus and we go, great, we've just made $100 trillion. But we don't even know how much it will cost, because we don't want a vaccine that costs too much for people to take. So the economics of a vaccine aren't even understood by the average person on the street. And this is a metaphor for the entire industry. There's 2 industries that I generally avoid, and it's banking and pharmaceuticals, because it's too complex and I have had many years of getting it wrong. So not because I think Moderna or INO or Novavax are bad, but because I don't know, I'm going to toss them.
Okay, big tech. So Facebook, Apple, Amazon, Netflix, Google, Microsoft. You want to be minders?
Yeah, I think so. I think it's keep. I think it's keep. Yeah, the strong get stronger. These guys have so much cash, we couldn't even believe it if we saw it.
FC,
Big fan, keep.
NVIDIA.
Yeah, it's a keeper. Yeah, yeah. If they get regulatory approval for the ARM, they're buying out ARM. It'll be a game changer for the tech industry. And NVIDIA's AI graphics, along with ARM's CPU, is going to be like the force to be reckoned with. Keep.
JP Morgan. Yeah, a bunch of people bought those post earnings.
Well, as I say, banking and pharma is not my strength, but banks are very closely linked to the economy, and stocks really trade based on the future. So I kind of think the economy, the long term, is a little uncertain. So I'd be more of a toss, but I'm not 100%. It's really, even the CEO, Jamie Dimon, told analysts that an economic recovery could stumble if there's another significant rise in coronavirus. So I'd be inclined to, I wouldn't be a big fan myself.
Okay, and then let's see, Shopify.
Keep.
Keep, okay. Okay, I'm just gonna see DocuSign. I'm gonna just put like three that were popping.
Keep. Love DocuSign.
And what else? I'm just gonna pick one. Twilio, because actually a bunch of people bought that when they had that big run. I think it went 60% up in a month or something.
Yeah, I love Twilio for the long term. Keep.
Okay, keep. And then our second game is, I know you love to hold everything long term, but we're always curious is what people would hold in shorter intervals. So if you had to, and this is assuming you have to buy it once we get off this call. Yeah? So right this very second.
Okay.
If you had to go into your brokerage account immediately we get off this call and you could only keep one stock for it, it's gonna be the only thing in your portfolio for one day, what would you buy?
The S&P 500, because then I don't lose all my money, I don't make a load of money, it's safe.
Okay, 1 week.
Oh, the same, S&P 500. Don't worry, I'm not going to answer that for everything, but I'm not a day trader, but I can see where you're going. And I'm going to give you better answers as we go further out.
Okay, so let's say a month.
Let me think. So for a month, I'm going to go a little more certain, less ambiguous than the SP. I'd go Google, which is, I'm not going to lose a fortune. I'm not going to make a fortune, but I'll go with Google.
To the end of the year. So let's do the next quarter. So till earnings, essentially. So one more quarter.
I go with Atlassian. Atlassian, their ticker's team. I think they're, yeah, I like Atlassian.
They're a great one. A year.
A year. I thought Atlassian was a year. You mean?
No, that was a quarter.
Quarter. Well, I'll go with Atlassian.
To the end of the year.
Okay, we'll go with Teladoc.
Okay.
Teladoc.
And finally, if you could have only one stock in your portfolio for the long term, so 10 years, forever, whatever, what would it be? Only one. We know we love diversification.
Okay, I used to say Disney. In fact, my whole life I said Disney because I used to say that, and I still believe, actually Disney is my second place. So let me tell you, Disney will be the king of entertainment when our great-grandchildren are old. It just will. But I think just to mix it up, Teladoc is going to change the way the whole world gets medical attention. Okay.
And so, just gonna do one question because I know we're at the hour mark, is if we want to get started building our portfolios now, regardless of whether we're new to investing or etc., how would you advise that we go? So, the first one is, guys, sign up for the workshop for Horizon.
Yeah.
We'll run through the 6 things, but how would you advise me, just like a general person who wants to start getting invested in?
So at the bedrock of your portfolio, so imagine you've bought into 6 golden rules, which I'll remind you are: get started, think long term, never borrow money to buy, diversify, buy what you believe in, and then invest what you can when you can, which means invest a little often. So imagine you said, okay, I'm on good with those 6 rules. I would say that everybody should put at the bedrock of their portfolio and leave for the rest of their lives a business that's so big that they have a high level of certainty it will always be around, because you need to look on it and feel reassured when you look into your portfolio that this is something I know and trust. And it could be Diageo, it could be Disney, but the first thing that I think everybody should buy is the S&P 500, because you are buying share in 500 companies in one click, and they are the 500, arguably the 500 best US companies, and it should sit there for the rest of your investing life. And I'll tell you why: because the S&P 500 historically has returned 10.5% per year. Now, some years it's down 10%, other years it's up 30%, the next year it could be down 20%, the next year it could be up 50%. But with 7-year perspective or longer, it returns 10.5% per year, which means your money doubles every 7 years. And I think every investor should start with the S&P 500 and then start to layer slightly riskier things in, but they will actually make the portfolio perform even better.
Okay, that's interesting. And one quick thing is, how should we be thinking about dividends? Because we spent a lot of time talking about capital gains. How should we be thinking about, investing, dividend payments? Just some quick advice on that.
Yes, so dividend investing is a great strategy if you're already rich. And so what I mean is that, like, you could, if you had $1 million, you can buy a dividend portfolio, and every year you'll get like $30,000, $40,000 in dividends. And if you have $2 million, you get $80,000. So definitely dividend investing has its place. If you want to go very conservative. I've never bought a stock because it paid dividends, but when I do buy one that pays dividends, I make sure I'm reinvesting those dividends back into the stock. So when Disney pays a dividend, I use them to buy more Disney. And there are some abilities out there for you to dividend reinvestment plan, a DRIP, where it does it automatically. But in short, it's very difficult to build a successful portfolio by saying I'm doing dividends and growth. They're very two different strategies. It's like, it's hard to build a house by the sea and inland. You got to do one or the other, So it's, so dividend portfolios for those people who just want regular cash coming in from their investments. And again, unless you have a lot of money, it's like, you want to get to be rich, you do that with growth stocks. And then when you're rich, you protect it by going into dividends.
Okay, so that's essentially, that's great. And, finally, where can we go for more resources, for more resources to learn more about the stock market? And a lot of people are, very curious about, learning more. Where would you advise us to go?
So there's 2 things, completely free and the highest quality. MyWallSt has an app called Learn, it's called Learn by MyWallSt. It's ranked #1 every country in the world by Apple for teaching people how to invest. And there's no ads, there's no sign up, there's no hooks. You just download Learn by MyWallSt, and it teaches how to invest. And the second place, and I'm really obviously plugging the stuff we do, MyWallSt does a podcast every 2 weeks called Stock Club. And like every other podcast, it's free. It's not an advert. There's no adverts. And Rory, who I think you might have met in the past, and I and James, Rory actually did a bamboo, he did do a bamboo seminar, but I don't know if it was with you, Yema. But Rory, James, and I talk about the stories and the best stocks that we have, our best ideas for investing and why. And there's a new episode out tomorrow, which is actually good fun. And we talk about Nikola and we talk about Apple's new products. So if you want to learn about companies specifically, listen to Stock Club podcast. If you want to learn about how to invest, download Learn by MyWallSt. And of course, Bamboo has a lot, and we're so delighted and privileged to be working with Bamboo because our best thinking is hardwired into your very beautiful app. Yes,
it's really awesome. Thanks so much for this, guys. So we've put the links to the workshop. We will send them. We'll send all this information again. And if you want to learn more about investing, you can go on MyWallSt.com and get signed up. They have a monthly. You can get signed up, get subscribed, and they give you so much more information. And at the final and our last question, which always comes to my mind, and I forget to ask everyone that comes, is we all spend so much time talking about diversification. How diverse is too diverse? So Horizon, you're building a 20 stock portfolio. How? At what point are we? Beating a dead horse?
Yeah, well, that's a good one, because there are some investors who say you should own no more than 12 stocks. And then there's Peter Lynch, who was one of the top performing investors in the history of the world. And he always had 2,000 stocks with Fidelity Magellan. So yeah, no, he was managing a lot of money. So, there's, but I think for a normal person going about their normal life, I kind of think between 20 and 30, but that's very personal. Like if you can look at 30 stocks in your portfolio and still understand where they all are and enjoy following it, you could go further. But I think you're really at the outer limit between 20 and 30, because like you should be free to live your life and not be a stock analyst,
Okay. Well, that's all the time we have. Emmett has actually given us 7 extra minutes, and I'm cognizant of the fact that it's a Thursday night and he has fun stuff to do. Thank you all so much for joining. Emmett, thank you so much for your time.
And I enjoyed it very much.
And yeah, so MyWallSt.com, guys, for more information and get investing at Bamboo. Bye, guys.
Bye.
How do I undo?